Hello, my dear friends. This is your friend Vivek Bajaj, co-founder StockEdge and Elearnmarkets. Welcome to yet another face-to-face global, and this is also going to be amazing learning for all of us. I'll tell you why. It's a very special video. When I started my career in financial market, I started with commodities, and I think everyone knows about it. And one of the critical factor driving commodities is weather. And the more I studied about commodities, the more I studied about the structure of earth and weather, I got 100% sure that the entire financial market ecosystem revolves around weather. And I was trying to figure out a person who can talk about this, the impact of weather on literally everything. I wanted someone who has a very deep understanding about weather and who probably is a meteorologist. So it was not very difficult because my friend Patrick, I recorded face to face with him related to precious metals. He suggested me a name, and today I'm going to record this amazing face to face with the gentleman. His name is Kevin, and he has amazing background, and you will get a absolutely new perspective about how to look at financial markets. So let me welcome Kevin. Hello, Kevin.
Hey Vivek, great to meet you. How are you doing?
Very nice. How are you doing? Good to see you.
I'm doing good. It's excited to talk to you today.
I am equally excited, knowing your background and what you have in offering to us. I'm very, very excited. So let's get into this. Let me know more about you. What has been your background? People will be very excited to know about your background. And then we get into the concept discussion.
Yeah, okay, great. Well, as you as you said, I'm a meteorologist. My background is 34 years in weather forecasting. I have spent most of my time working in aviation, doing meteorological forecasts for civil aviation and also for the Royal Air Force in the United Kingdom. So producing very detailed weather forecasts for pilots who are going to take quite a lot of risks in the way that they fly their aircraft and they fly combat missions. And it's a little bit more than your routine sort of public weather forecast where they just tell you it's going to be a little bit cloudy and the temperature up to 35 degrees and not to worry too much about it. But this is very detailed stuff. So they're wanting to know, where's the cloud, the bottom of the cloud, the top of the cloud, can they see the ground through the cloud, and a lot of detail around the atmosphere and what's going on in the atmosphere above the earth. So that involves a lot of careful analysis, and when you're forecasting a few days ahead, then you need to consider a lot of variables. So my background is in being able to look at and assess scientifically the variables that are involved in prediction and predicting the future. So really, that's where my interest in all of this came about. I made some investments when the stock markets weren't doing well and it looked like the banking system was in trouble. I didn't want to see my money disappearing and being eaten away by inflation. So I made some investments in gold. And I got interested in tracking what happens with the price of gold and whether it's possible to forecast where the price of gold is going to go, because you want to be buying it when it's cheap and you want to be cashing in when it's when it's at its top, and then rotating those profits into something else. Perhaps depends whether you're doing it for a long-term investment, of course. But anyway, so that's where my interest came from. My background is in risk assessment. It's in warning people, informing people, and communicating the information, which I think is really important, because it's one thing to be able to have the information, but being able to pass that information on to other people in a way that they can understand it and make use of it. It's no use me being really sort of, scientific and clever about things and being able to predict the future if I'm absolutely useless at trying to give that information to people so that they can use it. So part of my skills, I suppose, as a meteorologist, I've done some work with the BBC and I've been broadcasting with the BBC over the years. So part of my background is in broadcast media. And hopefully, fingers crossed, I've got at least some skills when it comes to being able to communicate all of that information.
That's amazing. Just as a bad sense of humor, I would like to share something. In India, there is also a department which tries to predict the weather, and we say that if they are saying it's going to rain, it is not going to rain for sure.
I'm afraid everybody loves to hate weather forecasters, but we believe it or not, and a lot of people listening to this probably won't believe it, but the science of weather forecasting and climate prediction has actually improved enormously over particularly the last 20 or 30 years. and that's because of the advent of supercomputers and computing power. And these computers are now able to simulate the Earth's atmosphere. So we're able to predict in much finer detail now things that we couldn't even dream of doing even just 10 or 15 years ago. So a lot of those views and attitudes that you talk about, where people say, well, if the weather forecaster says that, then it's going to do the opposite. A lot of that comes from 30, 40 years ago, and it's kind of getting passed on, and people, people like to believe that sort of thing. So that's fine. But when you actually look at the science and you do the analysis, you find that the meteorological predictions now are a lot more accurate than they used to be. It varies around the world, of course, because some parts of the world, the weather is incredibly difficult to forecast in great detail, although you can forecast the general trend change. So, for example, in India, with the onset of the monsoon and the rainy seasons, all of that is very large scale stuff. It's a little bit like the rotation of assets that are taking place at the moment from stock markets to commodities. It's a very big thing that's going on. So you can forecast quite well how these large areas of cloud and rain move in from the Bay of Bengal across India, get the continent right. And so those are the big scale things. But on a small scale, on a tiny scale, it's a little bit like trying to say, is the price of gold going to go up or down today? And that's the same as a weather forecaster trying to say, is there going to be rain in your town or village today? It's much, much harder. When you try and pin down minute local detail, that is more difficult. Getting the broad scale, large picture is a lot easier. And if you can spot those large scale changes, if you can spot the huge area of cloud and storms coming off the Bay of Bengal across India, then you know that your chances of getting severe rain and flooding are increasing. But you cannot say whether your town or village is going to get hit today or tomorrow or the next day. You just know that the risk is increasing. And it's the same in the markets at the moment. We know that the risk has increased for stock markets, and we know that the reward is increasing for commodities and precious metals.
All right. So, the relevance of weather is so high for India, especially we've been an agrarian economy. Large part of our population is dependent on agriculture. And if weather is supporting us, then the rural demand, India is like, there is India, which is urban, and there is Bharat, which is rural. And a lot of new demand in our economy and the GDP growth is driven by Bharat, right? And that is dependent on agriculture. So the whole science of studying weather and trying to predict whether rain will be good enough for our country and whether rural economy will do good because of that good rain, that is a big science. And a lot of people actually spend efforts in predicting a monsoon pattern for every year. So can I get an assessment before I get into the market discussion? Can I get an assessment from you with your experience of weather forecasting, that can a full monsoon cycle be predicted as accurate as possible? Is it possible?
Yeah, it is. And that what you're talking about there is the difference between day-to-day weather forecasting and kind of climate forecasting. If you're trying to predict what happens more than approximately 2 weeks ahead, so if you're trying to predict something that's a month in the future or 6 months in the future, that's more to do with the climate and the local climate. Climate can be measured and predicted over months, years, decades, or centuries. So as soon as you get out of the realms of weather forecasting, all of that other stuff in the future is called climate prediction. And climate prediction is becoming more reliable. It is becoming more accurate. And those cycles of rainy seasons, dry seasons in places like India and Africa and other tropical and subtropical countries that rely on that seasonal rainfall, those predictions rely on having to look at the evidence from a whole lot of different places. So you're looking at things like El Nino, which is ocean temperature changes off of the west coast of the United States of America, and it's hard to believe, but the temperature of the water in the off the west coast of America is going to affect how your rainy season pans out and how the monsoon season pans out. It's something called the Intertropical Convergence Zone, the ITCZ, and that's this sort of band of thunderstorms and torrential rain that moves north and south across the equator during the seasons. It moves north during the northern hemisphere summer, and it moves south during the northern hemisphere winter. And it's this oscillation of the weather patterns north and south that determines how extreme the monsoon season is. It determines when it starts, when it stops, how reliable it is. Of course, climate change is making a big difference to all of that. The climate is changing. There's nothing unusual about that. The climate has always changed throughout history. The fact that we've got billions and billions of human beings on the earth now does mean that we're having an effect on that climate. It would be foolish to think that we're not having an effect. So, anyone that tries to tell you that climate change isn't being affected by human beings is just ignoring the simple fact that billions and billions of human beings on the surface of the planet. We're putting stuff into the atmosphere, we're changing the what's on the ground, we're planting crops, we're replacing rainforests with cities and all this kind of thing, and it does affect the climate. It would be foolish to think that it doesn't. We do affect the climate. So trying to predict and forecast how that's going to happen in the next 10 years, 50 years is a really difficult science. But that gathering of the evidence is what's crucial, and it gives us a range of possible future outcomes. So whether you're going to get a reliable and good wet season in any particular year, that depends on all of these pieces of evidence: ocean temperature, where the jet streams are in the upper atmosphere, what the temperature is at the North Pole, what the temperature is at the South Pole, what's happening to the west of you, what's happening to the east of you. All of these things, and how the ocean currents interlink with each other, all of these things are pieces of evidence, and they change on a daily basis, they change on a weekly basis. So we make our forecast, and we don't just stick with that forecast. And this is where a lot of economic forecasters go wrong. They'll produce a forecast, and then they get kind of stuck with that forecast. They won't change it, even though the facts are changing. It's a little bit like cryptocurrencies recently. It was fascinating to watch that so many people refused to change their views and opinions. They were determined that Bitcoin is going to 100,000, and this is just a little blip. It's a little drop. Don't worry. It's only going to go down to 40,000. Oh, don't worry. It's only going to go down to 30,000. Oh, okay. Don't worry. It's going. Well, hang on. At what point in time do you admit that your prediction was wrong? Yeah. And that we're on a different path. Yeah. This is a different path. We're on a path to a bear market, and we don't know how low it's going to go. Probably a good deal lower than 20,000. Could well be, a few $1,000s for Bitcoin by the time all this is done. We don't know. But all we do know is that the evidence has been there for a long time now that Bitcoin and the cryptocurrency market is in a bear market. And so gathering all of this evidence together and being open-minded and flexible to change your forecast as the facts change, because the world around us, it's changing all of the time. So we produce our probabilistic forecast. It's a horse race, okay? Imagine a horse race. You've got 10 horses, and you know that half of them aren't very well. One of them's got a damaged leg, another one's got arthritis, another one's got some gastric problem because of something. And so anyway, you know the facts about the horses. You know which ones aren't going to run very well in the race. So you've narrowed down your probabilities. You've got maybe 3 or 4 horses that stand a chance of winning. And that's how predicting the future works. You use all of your analysis to narrow down the probabilities. You narrow down the outcomes, and you focus on the most likely outcome. It's never guaranteed, because the fittest horse could jump over a fence and break its leg. Yeah. Something unforeseen can happen. And at that point, you have to change your forecast. You change your prediction, because the facts have changed. And if you don't, then you're very foolish. So part of forecasting is gathering the evidence. The other part is identifying the most likely outcome. And the final part is being willing to change your forecast as soon as you know that the facts are changing.
Amazing. Lovely. Your experience of this whole weather forecasting is clearly coming out so well. And what a lovely analogy you have drawn. What I see that there is such a strong comparison. I mean, weather forecasting, patterns, and stock market or financial market, everything looks quite similar. So I would like to now get into deeper, because now that you are from there, you are now here into financial market. So how has been your journey, and what are the learnings we can get from you with respect to financial market forecasting?
Okay, great. Well, I'm going to share my screen with you. Hopefully you will be able to see what I'm about to show you. So just tell me if you can indeed see a picture of me and my colleague, Patrick.
Yes.
See that?
Yes.
Okay, great. So I'm going to move on to the first slide in the presentation, and let me just get the tools to work on this. Just bear with me a moment.
Before you start, I'd just like to tell my audience that I recorded an amazing face-to-face with Patrick So I'm going to send the link also of that face to face below this video. Please do have a look at that video. It will blow your mind.
Yeah, Patrick is incredible at what he does, and we work together, and we kind of we don't make any attempt to produce the same forecasts. We don't make any attempt to come to particular agreement, but we collaborate and we bounce our ideas off each other, and most of the time our thinking is in alignment. Sometimes we have slightly different views, but that's all good as long as you understand what I just told you, which is that we're identifying the most likely outcomes. And this is an example of that. This little picture that you can see on the screen here now, you're probably wondering what's this all about. Well, as a meteorologist and as a community of weather forecasters around the world, this is the technique that we all use now, because we have these powerful supercomputers. So on the left-hand side, you have a very small circle highlighted there, and that's the current conditions in your location. It could be the air temperature, for example. So the air temperature where you're sitting now, you might be 30 degrees Celsius, and you know that, and you're trying to forecast what's the temperature going to be in 24 hours time. So each of those lines, the green line, the blue line, the brown line, and the purple line, they're all a forecast from a different computer model. We tell the computer what we think is going on, and then we run the computer model, which predicts what's going to happen in the future. So between now and 24 hours time, each one of those lines represents what the temperature is doing. So 24 hours from now, you end up with a range of possibilities. The purple line is saying it's going to be warmer than it is at the moment, and the green line is saying it's actually going to be a little bit cooler than it is at the moment. Okay. So if the line goes up, it's warmer. If the line goes down, it's cooler. And this is called ensemble forecasting. The range of possible outcomes is called an ensemble. Okay. So no matter how much someone might try and tell you, and you listen to all these gurus who will say X is going to happen or Y is going to happen, and I'm absolutely certain about that. Well, as soon as you hear somebody say that, you, in my view anyway, you need to probably switch off and not listen to them anymore, because they're not acknowledging the simple fact that the future isn't completely fixed. It's a range of possible outcomes. You start off at the trunk of the tree, and as the future unfolds, you move out across the branches of the tree, and trying to identify which branch of the tree you're going to follow is the art of weather forecasting, the art of meteorology. So sometimes, and the point I'd like to make here next is sometimes these forecasts, and you can hopefully see the next image now, sometimes these forecasts will all arrive at the same point. Okay, so sometimes on this diagram you're looking at the moment, you've got temperature on the scale going up, and you've got time along the scale along the bottom. So starting at the current temperature on the left hand side, the initial conditions, we know what the initial conditions are to a high degree across your village or your town where you live, or your city. We know what the range of temperatures are across that city, with the range of atmospheric pressure, and all of the weather conditions are within a very tight range, and that's what's represented on the left-hand side. And then as you advance through the future and the forecast to 24 hours from now, there's a range of possible outcomes. And what you can see on this example is that most of the possible outcomes arrive at a similar point, which is just a little bit higher than the current point. So if this was a weather forecast, you would say that the temperature tomorrow is likely to be just a little bit more than it is today. But you'll also notice that there are two arrows that go quite a lot higher, and two or three arrows that go quite a lot lower. And this is the computer model telling us that this is the full range of possibilities. Small probability of being warmer than it is now, small probability of being cooler than it is now, but the greatest probability is with a temperature just a little bit above what it is at the moment. So on that occasion, we can have a high degree of confidence that the temperature is going to be just a little bit warmer than it is today. The high degree of confidence comes from the fact that most of the predictions are saying that. Low degree of confidence that it could be a little bit warmer or a little bit cooler, and you can't rule those out. So that's crucial. You can't rule out something that only has a 1% chance of happening. It can happen. Okay, if you're walking along the street and a meteorite lands at your feet, the chances of that happening are 1 in a billion, or one in many billions, or the chances of walking along the street and getting struck by lightning is very, very tiny. One in a billion people that will happen to, one in, so, but it happens. The point I'm making is that it does happen. So even if the possibility is very, very small, you cannot rule it out. So the crucial part of this is to spot the point at which the lines diverge from your forecast. So my forecast here would be it's going to be a bit warmer than tomorrow, but I'm keeping an eye on it to see if anything changes. And if along the journey between today and tomorrow, we can see that something is happening that is telling us that it's probably going to be a little bit warmer or a little bit cooler, then that gives us the early warning that one of these low probability outcomes is going to develop. And you can use exactly the same analogy with the price of gold. Price of gold today, somewhere around $1,850. I haven't actually looked today, but next week, if I'm trying to make a forecast, I'll weigh the evidence and tell my viewers and subscribers what is the most likely outcome. Is it going to be a little bit higher or a little bit lower? Okay. And then we'll monitor what happens between now and then. So this is how you produce a forecast. If you're going to do it scientifically, this is how you have to produce a forecast. There's no other way of doing it. Some people will use one particular technique and they'll say, this is what's going to happen. And they'll draw a nice line on the chart. And that is very conveniently ignoring the range of possible scenarios. And you shouldn't ever ignore the range of possible scenarios, because if you do that, then you're going to get caught out when things start to change from your expectations. There are, for example, people who thought that the stock market was going to have a melt up before it crashes. And this is a good example of that, because as things stand at the moment, that looks highly unlikely. It looks incredibly unlikely that we're going to see a stock market melt up before the big crash, which looks as though it is already beginning. To be honest, it looks like the topping pattern has already occurred, and that the S&P 500 and global stock markets generally, if we ignore emerging economies for the moment and commodity based economies, but Western economies certainly look as though their stock markets are topping. That's what the evidence is telling us. If something happens and we know what we need to happen for that evidence to change, we can show that on a chart, then we can change our forecast. But currently the forecast is that the top is in for the major stock markets in Western markets. So just moving on to the next slide, which I will do. Let's just get my little arrow cursor here. Okay, so moving on to how we put this into a forecast and how we use this information. This is just a little example running through how we've done it for the price of gold. So this was my gold prediction in 2019. You can see the top left-hand chart there, the 10-year base that formed. We're talking about gold priced in US dollars here. And at the time in 2019, I produced this prediction, and you can see the Twitter link there, which you're very welcome to copy into Twitter, and the tweet is there in 2019. And I was able to use a series of evidence, not just what's on the chart here, not just this arc formation, this blue cup formation, but a whole range of other background supporting evidence, which I haven't put on the chart because when I put something, as I said at the beginning, trying to get the information across to people is half of the battle. And if I put a lot of confusing data on the chart, then people will look at it and get very quickly switched off because they don't understand the chart. So I try and keep it simple. So the chart was drawn with the blue cup, the breakout, the red line, which is the breakout line, and then the target line, which is the upper blue line. So that's the target for the cup formation. And because we were stretched from the moving averages, I was expecting a pullback. The first little black arrow there shows a pullback, and then a fairly rapid move up to the all-time highs, and then a kind of a consolidation or handle pattern forming on the cup. Now, these cup and handle patterns are very common, and using a lot of weight of evidence techniques, it seemed to me that the most likely outcome after hitting the all-time highs was that we would form this pullback pattern that was a series of lower highs and lower lows, and that we would break out in 2022. I didn't know why the price of gold would break out in 2022, because this was 2019, 3 years into the future. I've got no idea about the fundamentals or what's going to be going on in the world. And somebody said to me at the time, be careful what you wish for, because if the price of gold is going to go up there, then something not very nice is going to be happening to cause that to happen, which is very true, you know. But fundamental people sometimes say to me, do you consider fundamentals? And the answer to that is, well, by looking at a price chart and looking at the evidence, you're automatically doing that, whether you realize it or not. You're looking at all of the fundamentals that everybody in the market knows about gold. So whatever you think about gold, and whatever the hedge fund managers think about gold, and whatever Goldman Sachs or Morgan Stanley or the Federal Reserve think about gold, it's all built into this chart. It's all shown on the price chart, and it is the only place you can look that actually gives you the truth about what is known about the fundamentals of gold. And using that chart, you can predict into the future. So I issued that forecast, and you can see on the bottom chart, on the bottom right-hand side there, that was the chart as of a few months ago. And you can see how the price moved exactly along the path that I indicated. It hit the all-time highs, it pulled back and formed that handle pattern, and it broke out as well. Crucially, it broke out in 2022, and the reason, supposedly the reason that it did that was because Russia invaded Ukraine, and there was a spike in the gold prices that took it up and out of that handle pattern. So there's an example of how the weight of evidence works. And of course, if anything had happened during that time period that made me think something else was going to happen, that something else was more likely, then I would have changed my forecast. But once you issue a forecast, if it's all panning out as you expect it to, then there's absolutely no need to change it. You just put out a regular update to the subscribers and people on Twitter, just saying, well, it's okay, the forecast is going as it is. Because of course a lot of people panic, the price of gold pulls back $100 and everyone's like, oh, what's going on, it's terrible, gold's going down to $1,000. Well, if you've got a roadmap like this, if you set your expectations, then it's all absolutely fine. It all just let it play out. It's no problem. It's all part of the long-term plan, and it takes away a lot of the worry and a lot of the concern if you have a forecast and you know that it's all part of that forecast.
Amazing. So this was actually, it's like, so I mean, we always thought that for future you need to contact God. How can this be so accurate?
Well, I'll be being completely honest, it's not possible all of the time to have your forecast work as beautifully as that. But I have to say that with the uranium market, with the commodities indexes like the Bloomberg Commodity Index, and with copper and with gold and with silver and all of the major markets, the calls that we made on all of those major markets have worked just as well as this chart. So it goes back to weather forecasting. Spotting the big capital flows is what's important. And if you can spot those shifts in capital flows, then the minute detail from day to day and week to week doesn't matter. If you look very closely at the chart there that I'm showing you, there are differences between my forecast and what actually happened. But when you step back and look at it as an overall prediction, it's pretty much about as good as you can hope to get. But when you look at the tiny details in it, there are points on that prediction where it went up $50 or $80, where I wasn't too worried where it was going to go up 100 or down 100. The main thing for me was that it followed that general forecast, and as long as it does that, it's absolutely fine. Of course, you can't nail down the exact timing week to week and day to day of when these turns happen. So just looking at what's going on more generally in the economy, and why we've got these capital flows shifting, and why we can have a high degree of confidence that the longer term future for precious metals is good, comes down to things like this chart. This is the US 10-year yield. It's the interest paid on US government debt of 10-year duration. And you can see on the left-hand side of the chart that during the 1970s, the 10-year yield was governed by a rising trend line. So interest rates were rising and yields were rising with them. And that was an era of high inflation and low economic growth for Western economies, more commonly known as stagflation, of course. Stagflation means high inflation and low growth. And during that time period, you probably don't need me to tell you that gold went up hundreds and hundreds of percent. It went up from Of course, the early 1970s coming off the gold standard at sort of $50, $100, those sort of levels. Then it went up to $200, $300, $400, and it went up hundreds and hundreds of percent. It ended up somewhere near $800. So it was a huge move up for gold, and at that time, of course, silver spiked to $50 with the Hunt brothers and everything else that happened around then as well. So that was a particular paradigm. That was a particular era for the global economy. We then saw this period of time where Western economies, following the Paul Volcker raising rates to very, very high levels in the United States and elsewhere across Western economies, interest rates went very, very high, and anybody who was around at that time paying for property and who had loans for property will know that those loans were very, very expensive. But then came the gradual cutting of interest rates after the high spike in interest rates. That inflation cooled off, and it was possible then to start reducing interest rates, and interest rates came down and down and down. And we started to develop what I've called on here the pain line. And it became the pain line as it was it's a resistance line that clearly couldn't be broken through. And if you stop and pause a moment, why that chart has failed to break through the pain line for decade after decade after decade, it's because as this time period has progressed, the United States has printed and printed and printed and printed, so that their debt to GDP is now very large, somewhere north of 130%. I can't remember what the number is now, but it's a large, large number. And what has changed over those decades is that the debt to GDP has gone from being sort of 50, 60, 70%. It's gone 80, 90, 100, 110, 120, 130. And that means that if you raise rates too far, the interest on that debt becomes mathematically very, very difficult to sustain. So your debt repayments start to outweigh your ability to pay. So it's a limiting factor. That line has been a limiting factor for a long, long time now. So I label that the pain line. I'm not an economist, I'm a weather forecaster, but I knew for a fact that if the 10-year yield crossed that line, there was going to be pain. And when people ask me, what do you mean by pain? I mean that the economy is going to really, really suffer. We're likely to see stock markets falling. We're likely to see interest rates rising. We're likely to see a whole lot of suffering because of all of what's gone on over the last 40 or 50 years in terms of increased debt burdens and people becoming so accustomed to cheap debt, 0% interest rates, interest-free credit, buy now, pay later, all of this kind of, all these things that we've become used to in Western economies has come home to roost. And the economic policies of the West over the last 50 years are not something I'm proud of. I mean, I live here in the United Kingdom, in the north of England, not far from Scotland, and our politicians and our economists and our central bankers have let us down very, very badly, and they seem to be run by infants, to be honest, because if they didn't see this coming, and if they didn't understand it, and if they didn't want to try and avoid it, then there's something wrong with them, because this is going to have incredibly serious consequences for all of us for a long, long time. It's not good. So just to illustrate that this is of a historic nature, this is the German Producer Price Index. So Germany is the powerhouse of Europe in terms of financial strength and has bankrolled a lot of the southern European economies for a long time, bailing the banks out during the banking crisis. You probably remember Germany effectively bailing out Greece when Greece became, to all intents and purposes, bankrupt. So if anything goes wrong with the German economy, then the consequences across the European Union are going to be very, very large indeed. Now, I don't know, I haven't seen a lot of people paying a lot of attention to this, and it really is something that should shock people, and people should look at this and realize that what's happening now, it's not just unusual, it's not just a little bit out of the ordinary. It's historic. It's truly historic to see the producer price index in Germany higher than it was, not just during the 1970s, but higher than it was post World War II, when German reparations for World War II were, costing the German economy. I find this absolutely staggering. That even after World War II, the PPI, the producer price index, at that point when the world was and Germany was in complete tatters and it was a complete disaster. We're worse now as measured by the producer price index. So input price, this is input prices for producers. Now, of course, those input prices for producers, they can be absorbed for a period of time, but not for long. They eventually, if it stays high, it's got to be passed on to the consumers. So the consumer price index rises. Consumer price indexes rise, then we all know what that does in terms of inflation. So the inflationary effects of this, and this particular chart is what made me realize that when Janet Yellen was saying, oh, it's transitory, don't worry about it, we're going to get inflation back down to 3%, no trouble. Well, that was complete garbage, and this chart told us it was garbage. And the economists in the United States advising the Federal Reserve must see charts like this, and they must know what's going on, but they therefore treat us as idiots because they expect us to not notice what's going on. This is US government debt. I mean, US government debt is parabolic, and it has been for some time. We're reaching the sort of very vertical stage of this parabola now. And for anyone that's not sort of particularly familiar with what a parabola is, that red line is a parabolic line. So it starts off very shallow, and then it gets steeper and steeper and steeper. And the point about a parabola is that it ends up being vertical. It just goes straight up, which is unsustainable in any system. Anything that just goes straight up, whether it's imagine the temperature going straight up 30 degrees, 40 degrees, 50 degrees, 60 degrees, 70 degrees, it gets to those sort of levels, and the human race would be dead. So it's not sustainable if we want to carry on living. And the same thing goes for US government debt. It's not sustainable if the US government wants to carry on existing, and if the United States itself wants to carry on existing. So it raises the question, how do we get out of this particular trend? This is the forecast. It's going vertical, and it's self-reinforcing. Once you get into this sort of cycle that results in a parabola, a lot of feedback loops are taking effect that mean in order to sustain your standard of living in Western economies, more and more money needs to be printed to sustain that, as inflation gets out of control, and the whole thing just turns into a big snowball that gets worse and worse and worse. And along with that is this particular chart here, which is the consumer price index. Sorry, I'm just glancing across at my left-hand screen here because I've got what you're looking at is on a screen to my left here.
Yeah, it's okay.
So this is the consumer price index, and you can see, this is the consumer price index. So you can see how shallow it is on the left-hand side of the chart there back in the 1950s and 60s. So consumer prices were rising at a more contained rate. And then as we hit the 1970s, the consumer price index sort of took on a more steeply angled trajectory. So consumer prices and the consumer price index was on more of a steadily increasing rate. And a lot of this is, you think about house prices, and you think about property prices and land prices. We're not just talking about the price of bread and things like that. This is this wide range of measures, and in fact I believe the measures and how it's measured has probably changed over the years as well, so it's a little bit debatable just how comparable current data is with past data. But the main point to notice here is that this also is going vertical. So the consumer price index is rising at an unsustainable rate, the rate at which it is rising. So something has to stop it, and if it doesn't, we're in serious trouble here. So it's another measure of just how historic the current situation is. So historic things going on in the background with the economy. So expect historic consequences that we are all going to notice. So whatever has gone on in the last 50 years with, I'm talking primarily about Western economies here, because I believe that commodity-based economies are going to fare much better and be better protected. So India, Brazil, China, probably Russia, Canada, perhaps, Australia, any of these kind of South American economies as well, that are able to produce and export the commodities and the raw materials that we need. The countries which have energy reserves. Africa, I should have mentioned Africa, of course, because Africa is going to be, I believe, very much a rising force in the era to come. So what I'm describing really is the decay of Western dominance in global politics and everything else, and the gradual transition, which I think we've all heard about, and perhaps some of us have become a little bit switched off to it, and is it really happening? I've heard this all before. This rise of power in the East and decline of power in the West. Well, we're actually witnessing it now. I mean, if you just listen to what's going on in global news at the moment with Russia and China and their moves on Taiwan and Ukraine and all of this, it's all tied in with this very, very large shift of power that's taking place, and positioning for this change is going to be really, really important. Currency in circulation. This is the US currency in circulation, and it shows the desperation of the United States at the moment. I mean, the black line there is the currency in circulation rising 2272. I guess that is $1 trillion. I would have to double check the units on the graph there, but this is data is taken from TradingView, of course. And the point here is that the graph is not only rising rapidly, it's rising probably faster than a parabolic curve. It's already in its sort of vertical stage and has been for quite a while. So currency in circulation is another measure of money printing. It's another way of explaining the inflation that's going on around us. Of course, if you print lots of money, prices are going to go up. Any sort of country in history that just resorts to the printing presses and prints more money and more money and more money. Look at Weimar Germany, 100 years ago. This is exactly what happened there, and the currency becomes confetti. You go from, well, you don't need me to tell you this, and I'm sure you don't need your listeners to tell you this. When your currency, if you can buy a loaf of bread or a bag of rice or beans for 10 units of currency, that's great. But then if it becomes 100 units of currency or 1,000 units of currency or 10,000 units of currency, that starts to tell you something, and it's telling you that stuff is getting out of control and needs to be reset somehow or other. This all needs to be reset, and it will be reset, but it probably won't be a peaceful process. This chart here is one where we can start looking at these capital flows. So this is comparing the SPX, so the stock market in the United States, with gold, and I could have chosen pretty much any global stock market at the moment, although the commodity related countries would have a slightly better outlook than this. But this is more particularly in relation to capital flows related to gold. So you can see on the chart there, when you compare the SPX to gold, so this is the ratio of the US stock markets to gold, you can see that there's a clear repeating pattern there, and you can see these breakout lines and the breakdown lines. You get an uptrend, as we saw there, leading up to 1929, 1967, and the year 2000. You get these uptrend lines that support the price, that support the chart moving up. And during that period, you would be better in equities than in gold. But when it hits the top line, that's where you need to rotate out of equities and into gold. And in fact, since the year 2000, the better place to be has been gold. And that might shock a lot of people, but gold has performed better overall since the year 2000. Gold was $250 in 2000, and today it's nearly $2,000. So, that's something like 700 or 800% higher than it was in 2000. And the S&P hasn't been able to match that. And it's, of course, rolling over again now. So having formed a bearish rising wedge, and that's what that little wedge pattern from 2011 to now, that's called a bearish rising wedge. And when a chart forms that pattern, the probability is that the price is going to break down. And that's what's happened. The price has broken down. It's tried to back test that wedge. It's tried to sort of get back to that line, and it's slipping away again. So this is one piece of evidence that gold is about to more seriously outperform the SPX. Now, there's a number of possible scenarios from this point in time going forwards, and gold going up rapidly is one possible scenario. There's a little hiccup in that journey, though, because there's a small possibility of a sizable pullback at the moment, and that's because the markets are falling so quickly. When the markets fall this fast, gold and everything else can get dragged down with it for a short period of time. But as the process develops, then the evidence is that the stock markets are going to really, really struggle, and the precious metals are really, really going to do very, very well indeed. So regardless whether, if gold pulls back a little bit or even a lot, there's one scenario where gold could come down to $1,400 or $1,500 at some point in the next 12 months. And if that does happen, then great, buy it with both hands, because that's a buying opportunity. It's a case of buying, holding, and adding on weakness. So during this general trend, stick with it, stick with the trend, stick with precious metals, and just, as I say, buy, hold, and add on weakness. This is another piece of evidence that shows the likelihood that precious metals are going to do well. And this is the US 30 yield divided by the 10-year yield. Now, myself and Patrick, we come up with all sorts of weird and wonderful charts, and we try looking at different ratios and seeing how they correlate to the price of gold and to precious metals. And you can find these correlations that help to give you the evidence that gold is closer to a bottom than a top at the moment. And this is one of those pieces of evidence. Each time the 30 yield divided by the 10-year yield hits 1%, then that marks the bottom for the price of gold. You can see September 2018, October 2008, March 06, and April 2000 there. That's when the price of gold was at a low point. Okay, each one of those orange circles on that chart, and you can see the gold chart underneath it. So you can see I've drawn a vertical line, and you can see at each of those low points, gold bottoms and then moves up. So we're at that point now, at that 1% point, where according to this analysis, and this is just one piece of evidence, one of those many pieces of evidence, that's telling us that we are very close to gold making a turn here and going on a significant move to the upside. So it's all about building this evidence case. You don't just look at one piece of evidence. If I produce a forecast that says gold is going up, I'm not happy with that. I don't want to sit back and just kind of be smug about it. I want to test it. And part of being a weather forecaster is testing. That's part of being a scientist. So any kind of scientist will tell you that part of the discipline of being a scientist is to test your thesis over and over and over again to make sure that you're not wrong. No scientist wants to be wrong. The whole point of science is to be correct and to help. We want to help. We don't want to make things worse. So producing a forecast is great, but then you have to test it and test it and test it and test it and keep building the evidence. And you weigh up the evidence that says gold is going to go up and the evidence that says gold is going to go down. And that balance is changing all the time. It's like a set of scales, evidence that it's going to go up, evidence that it's going to go down, and you're weighing the set of scales the whole time, and you're piling the evidence on to see which way gold is going to go. So this is one piece of evidence, quite a strong piece of evidence, you have to say, and the evidence is stronger the more history it's got. So if this had only happened twice in the past and given you the result of gold going up, then it wouldn't be very strong evidence. But you can see it's happened several times in the past, all the way back to this data series doesn't go back any further than that, unfortunately, on this particular chart. But time and time again, it's proven to be accurate. So it kind of adds to the strength of the weight of evidence.
So I have one question on this previous chart, Kevin.
Yeah.
Logically, if suppose yield is expected to go up, let's assume 30-year yield, which is 3.27 right now, and with the inflation going up, yield is expected to go up. Logically, people should not invest in gold, right? Because if government bond is giving me higher yield, why will I invest in gold?
Well, that's a question you could have asked in the 1970s as well. So go back to that chart that I showed earlier on in the presentation. You could see how the yields were rising.
Yeah.
And this is I'm trying to get people out of the mindset of the last 50 years, because we're so accustomed to the declining nature of these charts, and gold responding to money printing and responding to decreases in interest rates, because the perception has been that these measures are being done out of desperation to save the economy, and therefore there's a risk, and when there's risk, gold does well. But we're now moving into an era where, going from being a kind of a little bit of a risk, as demonstrated by desperate measures of the Federal Reserve, we're now moving into an era where it's not a risk, it's actually happening. All the bad stuff that we feared might happen is happening. So as in the 1970s, with high inflation, low economic growth, stagflation, and rising rates, that is exactly the recipe that gave us gold going up by hundreds and hundreds and hundreds of percent. So I have to kind of stand back a little bit and declare that I'm not an economist, so I can't explain in huge, minute detail the workings of why that happens that way. All I can do as a scientist is observe the input factors that cause the outcome to occur. And very, very much what's happening now is what happened in the 1970s. So that breaking out of the yields and the moving up of the yields is exactly what happened in the 1970s, and it's exactly what caused gold to do what it did. So try to shift from expectations of the last 40 years and look in great detail at what happened, in fact, not just in the 1970s, but I think back in the 1940s as well, during that wartime period. Sort of 1930s, 40s time, there are comparables as well, although of course it's harder to get data that goes back that far. So when you're doing technical chart analysis, it's a lot trickier, but at least we do have the 1970s to look at. So I would point you to the 1970s as an answer to that, Vivek. This is another chart that we show that I really want to draw your viewers' attention to, because people look at the US dollar index and make a lot of conclusions about it and what it means for gold. The US dollar index, bear in mind, it's moved from around about 90 to 105. And what has gold done during that period? Has it crashed? Has gold gone down? No, it hasn't. Gold has actually stayed roughly the same, $1,800. So the US dollar index has gone up from 90 to 105. If I told you a year ago that the US dollar index was going to go from 90 to 105, you'd be expecting gold to have gone down enormously, and it hasn't. I know it's been a bit frustrating that gold hasn't gone up, but it hasn't gone down either. It's gone sideways in a consolidation. And the reason for that is inflation. The reason for that is people forget to adjust the dollar index for inflation. Now, if you think about it, you might think I'm stupid to adjust an index for inflation, because the US dollar index is an index that compares the US dollar to primarily the euro, but also the Japanese yen and the British pound and a couple of others. But it's primarily the euro that the dollar index is. It's about 60% of the index. So how can you compare an index to inflation? Well, the answer is that at any point in time, the US dollar has to be gaining against the euro by more than inflation to have any effect. If the US dollar index and its move against the euro, so if it's gone up, I don't know, 5% in the last year, that's absolutely no consequence if inflation is 9%. And that explains why gold hasn't crashed down. So during that 1 year period, DXY has gone up. The DXY number, which over the last 50 years has varied between about 60 and 160. So that number that we're accustomed to, it fluctuates up and down, and it's gone up from 90 to 105 in the last several months. But that rise, that strength of the US dollar against the euro has not been enough to overcome inflation. Inflation is the bigger force at the moment, and that's been the problem. So we don't need to fear DXY going up for gold. Yes, it acts as a headwind, and it doesn't help gold to rise, but it doesn't cause gold to fall if inflation is the greater force. You're measuring forces here, and if inflation is the greater force, then we don't need to worry about DXY. And this particular chart is DXY adjusted for inflation, and we use the producer price index as a proxy for inflation. Okay. So it's DXY divided by the producer price index for all commodities in the United States. And you can see very clearly that regardless of the DXY chart having 3 notable peaks on it, on this particular chart, the entire thing is just a ladder that is taking us down. And you can spot that each breakdown, 2021, 2002, 1985, they were all points in time when the gold market had a very good run. Even in 1985, which is not particularly remembered for being a good time in gold, gold went up 60% as this chart broke down, and that was in a disinflationary environment. That was in an environment where inflation was coming down. So that's disinflation. When the inflation rate is coming down, it's disinflation. You still have inflation, but it's heading downwards. So in a disinflationary environment where forward expectations of inflation are lower and lower and lower, gold still managed to go up 60%. Now, what's happening now is that it's broken down, just as it did in 2002, and that was in a disinflationary environment as well. And gold went up 600%. So it's broken down again, but forward expectations of inflation and this stagflationary environment mean that the likely rise in gold is going to be large. I mean, very large. So the coming years and the coming era of investment is going to be very, very different, and it's likely to be comparable to the 1970s. And you can see on the far left-hand side of the chart there, gold up 800% in an inflationary environment. So that's the type of scenario that we think is realistic for the coming few years.
Amazing.
Go to the SPX rate. Sorry, yeah, Vivek.
No, it's brilliant. The last slide was amazing. The whole the inference out of that slide was amazing.
Yeah, it's really, really important that people don't look at things in isolation. You just have to look at the big picture. And this is where the forecasting background comes in, because I'm always looking at everything that's going on around the thing that we're looking at. And if we're looking at gold, I want to know everything that's going on around it. This is the gold to SPX ratio. So I want to know, is the ratio favoring the stock market or is it favoring gold? And this ratio and the pattern that it's building out is a classic arc pattern, a classic basing formation, which is telling me that the likelihood is that we have now hit the bottom of this ratio, the little orange circle on there, where now the chart is moving upwards. And when the chart moves upwards, it means that gold is performing better than the stock market. When the gold chart comes down, it means that the stock market is performing better than gold. So over the last few years, the stock market has performed better than gold as a whole. Casting your mind back to the previous chart, though, over the last 20 years, gold has actually still outperformed the stock market. So if this chart went back a little bit further, you would see that gold has outperformed the stock market over the last 21, 22 years since the year 2000. But on this time frame here, since around about 2011, 2012, when gold peaked, the stock market has outperformed gold. But this particular pattern that we see here, we're starting to build evidence gradually that the ratio is favoring precious metals. Something I haven't mentioned so far is uranium, and uranium stocks, along with, I think, platinum, are probably the two that are most likely to outperform to a very high degree over the coming years. This is the URA ETF, so it's the exchange traded fund, which is basically a whole lot of uranium miners in one sort of fund. So it gives you the average price movements of a number of uranium miners. Of course, uranium's had a very long bear market, which ended a couple of years ago and has moved quite strongly to the upside. But even so, we're just in the very, very early stages of the uranium bull market, and we've just had a little bit of well, in fact, not a little bit, quite large pullback in the uranium miners, which is presenting a very good buying opportunity for anybody that hasn't positioned themselves with uranium miners. And I'm not a financial advisor, I've got to say that, but any good financial advisor, no doubt, would tell you that a diversified portfolio is a good idea. So physical metal is great. If you can buy some mining stocks, that's great. And if you can include a few uranium miners in that, that would be great. The commodities are doing great at the moment, and so diversifying across a number of different different areas is always a good thing to do. But look at this ratio. Just incredible to see just how much this has come down and what the potential is on the way back up again. So there's a huge arc that's formed here. We're breaking out. You can see the red circle there. There's a breakout through a declining resistance line. We've got a horizontal breakout line that's marked on the chart for you. As soon as we get above that horizontal breakout line and start making some moves to the upside, this is going to be a really interesting sector to watch. I mean, some of the gains here can be measured in thousands of percent, the projected gains in the uranium miners. Back to my weather forecasting sort of background, climate change, we are relying on nuclear power to allow us to reduce global emissions, and we've got programs all across the world with mini nuclear reactors, which are small, they're safe, they don't cause the landscape to look terrible. They're able to make these nuclear reactors now so that you wouldn't even know they were there almost. So nuclear power, modular nuclear reactors, and the whole industry is looking very bright. And with all of the underinvestment of the last couple of decades, then the demand and supply equation is very much supportive. But regardless of that, just look at that chart. I mean, the ratio looks poised to massively favor URA compared to the S&P over the next several years. This is the gold chart, and I've done the gold chart in rupees for you here. You can see that we also have a very clear arc pattern here, and anyone that follows me will know that I use these arc patterns a lot because they're all over the place in price charts, and they're very much underutilized because when you spot them, they make very strong evidence for a base forming, and this is just how the price builds out. And you may have heard of Wyckoff accumulation and Wyckoff distribution patterns. It's another way of representing that, and also Stan Weinstein's stage analysis. And I can recommend his book as well, by the way, if you're interested in all this technical chart analysis. It's written in a way that people can easily understand. So if you can get your hands on Stan Weinstein's How to Profit in Bull and Bear Markets book, then that's recommended reading. But this basing pattern is another way of representing what Stan Weinstein describes in his book, and also the Wyckoff accumulation pattern. This little red square in the top right-hand corner is the price consolidating after completing its destiny, and its destiny was to reach the right-hand corner of that arc. That's not the end of the journey, of course, because now we're getting ready for the next move, and all of the evidence, as I say, has been suggesting that the next move will be to the upside. And this is the same chart, but it's for the US dollar. It's for gold priced in US dollars. And this is the same chart, but it goes back further in time. So you can see what happened the last time one of these arcs built out around about the year 2000. So it puts it in context for you as to what can happen. The arc completed, price consolidated in the top right-hand corner of the arc. And then we all know what happened next. Price of gold went up and up and up and up and up by hundreds of percent. We've formed another base over the last 16-year base there, with a small arc in the top right-hand corner of that larger arc. So these patterns, as you can see, they repeat over and over and over again. By using this technical chart analysis and all the things that I've explained to you today, we can weigh the probabilities of the future outcomes, and that is how we do it. That's how we do it. So I hope that's been enlightening for your viewers.
I don't have words. I think this is like real connecting the dots, and I can clearly see your experience of weather forecasting coming into play here. So you have an advantage.
Well, it does help. Yes, I'll just stop the screen sharing there. I hope that's okay.
Yeah.
But yes, it does. it does help, and everybody who does this comes to it with a different background. You know, Patrick's background is in computer programming. He's got a very sort of logical mind, and it's incredible. I'm talking to people and very experienced technical analysts and chart commentators and economists over the years, that you don't need to. In fact, it's very, very helpful sometimes for someone to come into this who has a completely different background, different way of looking at things, because they can shed light into dark corners of technical chart analysis and prediction and forecasting that you might never have thought of. So, you know, I'm learning, we're all learning. That's what it's all about. I mean, that's you know, that's what you're about. You know, we want everybody to learn and understand. And I don't want to sit here and for people to think that I have all of the answers. I don't have all of the answers. I am contributing to the discussion, bringing my perspective, which I hope, you know, I hope for some people it will help them. People learn in different ways. People have different ways of learning. They'll learn at different speeds, and the way I explain things might not, you know, some people might not like it. They might not understand it.
Yep.
But hopefully some people, it works for some people. And if it does, and if my way of explaining what's happening helps, then that's great.
Cool. I want to get into the the important question. Now that the forecast is there, gold is going to be strong, and I'm convinced with that. Now, how do I trade? Because if I trade futures, then the volatility will always disturb me, right? If I trade options, and if I'm a buyer of options, then the time value will disturb me. So what's the right way to trade bigger swings in the market?
Well, with this whole process that I've been describing, it's about spotting the capital flows. It's about spotting this huge shifting of the tide. Okay, and it's about not panicking. It's about not being frightened out of your positions, and it's about minimizing risk. And the world that we're about to enter, the next 10 years, without getting too dramatic about it, there's a lot of risk. Geopolitically, there's a lot of risk, and it's quite a frightening prospect, really, you know, what could happen. So I suppose I would have to say that allocating a reasonable amount in physical gold, silver, precious metals that you can get your hands on, that you can use, that provides a sort of a guaranteed, you can't lose it. It won't ever disappear. It'll always have value, whatever happens. So physical metals, I think everybody, you know, probably should consider having a portion allocated in that. Aside from that, my personal preference is to buy the shares, because the shares leverage the price of gold and silver and platinum. Okay. So I always prefer, because it's easy. You download an app on your phone with a reputable share trading platform. I use in the UK Hargreaves Lansdown, Interactive Investor. There are others all around the world which are, you know, big global companies. And I would always say, and again, I'm not a financial advisor, I'd always say never use one platform. So for those who are, you know, trading cryptocurrencies, or using one platform, or just buying, you know, a handful of the cryptocurrencies, for example, that was a big risk. Because if the platform goes down, your money goes with it. And the same with brokers, you know, they tend to be regulated by government, so that if you ever have any issues with your broker, the government should step in and cover your losses. But that varies from country to country. So I would probably recommend having, you know, 2 or 3 different broker accounts, and just putting a little bit of money into that each month, and deciding which miners to buy. For safety, the bigger miners, the large cap stocks like Barrick Gold, like First Majestic Silver, the ones that the hedge fund managers are more likely to be looking at. So you can look at the constituents of the HUI index or the GDX index. Those are the big global ETF metals ETFs. So you can Google that, you can go online, you can find out what's in the GDX and what's in the HUI index, and those Yamana, Newmont Gold, those big companies. So sure. those are the safer ones. But if you want to make, you know, if you want to take a little bit more of a risk and potentially make bigger gains as the bull market develops, then the junior miners are where you get the big profits. So the constituents of SILJ and GDXJ, where you get smaller cap stocks, and there's any number of small cap stocks, but I'd have to urge caution, because a lot a lot of these companies get pushed on social media. And when you look at the chart, when me and Patrick look at the charts, we just wouldn't touch them with a 10-foot pole because the chart looks terrible. There's no evidence to suggest that these junior mining companies are about to do anything exciting. You have to wait for the evidence, which is what me and Pat do. You know, we provide that sort of evidence base. And so when these companies do have the evidence to suggest that they're about to do something really interesting, then we're happy to sort of put those charts out on our website and so on. But you got to be careful. You got to be very careful, because you can end up, you know, putting money in a company and it suddenly goes down 80-90%, and it's not good. It's not good. So spread your risk. Futures I don't get involved in. It's not something I've ever particularly considered as being particularly advantageous. The miners provide a high enough leverage for me.
So you think it's better to invest in gold ETFs? Because I think you're taking direct exposure to gold in that case.
Yeah, I mean, the ETFs are a quick way of being able to have a position in a large number of these miners. So the ETF itself is, but you know, it's possible and not that difficult to actually work out which are the outperformers within that ETF. So within GDX, there are some stocks that are dragging it down, and there are other stocks that are doing very, very well. And you can spot that on a technical analysis chart. You can spot that. So it's a little bit of a shame sometimes to invest in an ETF when you could actually, instead of doing that, you could pick 20 stocks that are the outperformers.
So Kevin, the problem is that in India, we don't have these gold miners. So the most proxy investment in gold has to be the ETF, which invests directly in the gold and keep it as part of the warehouse.
Yeah, if you're unable to have an overseas account or anything like that and get access to being able to buy the mining stocks, then the ETFs are a good proxy for that. And GDXJ and SILJ, for example, and the HUI index, they're all perfectly reasonable ETFs to look at. Yeah.
All right. So super. This was amazing. Really loved it. Maybe a follow-on discussion on the impact of this whole weather changes on equity as an asset class. Someday I'll get an opportunity to do a follow-on discussion with you, because that still remains unanswered. That how do I judge that based on my understanding of where the weather is going? But I'm satisfied with what I've got from you. Gold is very important asset for we Indians. We are the highest investors in gold. We hold gold quite a lot. So I'm sure this perspective about gold will help all of us and plan our future financial goals as well. Thank you, Kevin. It was a pleasure talking to you.
Thank you, Vivek. It's been great.
We learned so much from you, connecting the dots, the macros, everything. So it was great exercise. And I'm sure people would love to follow you. So your Twitter handle, I will be sharing below the video. So just a small request, if you get few queries from people in India, your learners from India, please do reply to them.
Yes, we'll do. We always reply to people sending questions. Yeah, no problem.
Thank you. Thank you so much. Have a great day ahead and take care of yourself.
Okay, great. Thanks, Vivek.
Thank you.
Bye-bye for now. Bye.